The first session of 2016 for most markets has been very volatile already. Volumes, of course, are still pretty low around the world, but it has been some dramatic moves over the weekend and also with the data flow in Asia today. Announcements that Saudi Arabia had executed a Shia cleric and that Iranian protesters had burnt down the Saudi Arabian embassy, and then that diplomatic ties had now been cut between the two countries has sent a major rally in the oil price in the Asian session here. That has really helped move energy stocks upwards, and initially that move seemed to be a positive in that it was lessening some of the pressure on the high-yield bond sector, with US futures moving up strongly earlier in the Asian session. However, this was not to last for the rest of the day, with the Chinese currency fix coming out much weaker today, with now a 0.5% weakening in the currency midpoint over the past 5 days, which saw some major moves in currencies globally, leading to a lot of US dollar buying as moves were as US dollars were bought and Chinese CNY was sold. We saw that movement happening across a range of currencies globally. And then we had the Chinese Taishin manufacturing PMI release today, which came in far below consensus estimates for about a 48.9 reading. It came in at 48.2, much lower even than the previous month of 48.6. Now, what this seems to be driven by is a lack of credit getting to the small and medium enterprises in China, which dominate the Taishin index, unlike the MBS PMI, which was released on the 1st, which did see some improvement, largely driven by the fact that large enterprises are getting better access to state-directed credit. Nonetheless, that big miss in the Chinese Taishin PMI alongside the weakening in the CNY seems to have driven some real concerns in the Asian session, and particularly over in the Chinese markets, which are seeing some of their worst sell-offs in many weeks. Significant selling in all the mainland indices and also the Hong Kong markets. But this has been mirrored across the region, with the Japanese markets down by over 2% as well. The ASX is also in negative territory, but compared to China and Japanese markets has held up far better. Much of that driven by strong moves in healthcare and energy stocks today. But the lack of buying in the banks and indeed the negative performance by the banks on the ASX has been one of the major contributing factors to the poor performance of the index. But it hasn't been infected with the concern that we are seeing in the rest of Asia. And there has been a noticeable rally in the Japanese yen today, some significant safe haven buying over China growth concerns leading into 2016. Of course, we will see a drop-off in the Chinese data as it closes down for the Chinese New Year at the end of January and into February. And those concerns and this consistent seasonal drop-off in Chinese economic data in the first quarter of the year are certainly growing to concerns about what 2016 might hold for the pivotal Chinese economy this year.